Hello, this is Taylor. Oh boy, are we due for a personal finance update, am I right, guys? There have been major changes since the last strictly personal finance video that I put out like over 800 days ago, I checked. The main change being that I am now self-employed, which is actually helpful context if you're new here. Hi, I'm Taylor. I'm 26 years old, formerly a full-time management consultant and creator, recently turned full-time creator, living in New York City. And as you might be able to tell, this isn't New York City. I don't think I could have a more British background if I tried, but I am currently traveling in London. Fun fact, that is the hospital that Kate Middleton stayed at a few months ago. Not fun fact, but you know what I mean, it's a fact. So today we're gonna cover all of the personal finance things, starting with a brief rundown of my income streams, a reminder of what my personal finance strategy was when I had a corporate job because it's important context, followed by what my strategy looks like now that I'm self-employed, and finally a word on what I think of my current system and how I'd like to change it in the future. Okay, starting off with my income streams to contextualize this video. Currently, in order of magnitude, my income streams come from number one, brand deals or sponsorships that I do in my YouTube videos. 2 is YouTube ad revenue, and 3 is affiliate marketing, which is a very tiny portion of my income piece, but it's not zero. And there are a couple other streams that I am so excited for that I'm gonna touch on at the end of the video, so stay tuned. And to be the first ones to hear about it, join my email newsletter, link in description. Now, let's quickly cover what I used to do when I had a corporate job. And I think that this is important to highlight because I actually think my old method is what you should do if you are a young professional entering the workforce or entering the world of making money. For example, taking advantage of retirement accounts that your employer may set up for you, versus what I do now is not quite as straightforward because the self-employment complicates a couple things, but don't worry, we'll cover both. So for my first few years of working in a corporate job, for any dollar that came my way, I sort of thought about it as like filters that it would flow through. Kind of like this, like a Anyway, so first filter, I would take care of my needs. So things like paying off credit cards, paying for rent, for food, things that I need, you get it. Next filter, prepare yourself, a little dry. We're gonna get into retirement accounts for a second, but stay with me. After my first filter of needs, I would then max out my 401k retirement account that was offered by my employer. And at the time, I chose to put 100% of my contributions in a Roth 401k versus a traditional 401k because Roth is funded with after-tax dollars. And call me crazy, but I plan to be in a higher tax bracket when I withdraw those funds many years from now, so I'd rather pay taxes on it now than later on, if that makes sense. And for 401ks, if your employer will match your contributions, I highly recommend putting in at least as much as your employer will match because that is literally free money. And typical 401k employers usually match between 3 to 6% of your salary, so it's a non-trivial amount. I no longer have access to this, which we will cover in a bit, but yes, take advantage of that if you can afford to. After the Roth 401k, I would then max out my Roth IRA, which is another type of post-tax retirement account. And I still max out my Roth IRA because I can as a self-employed person, but I have to do it a little bit differently now. I'll cover that in a bit. Okay, last boring filter, I promise, and then we'll get to the slightly more interesting filters. I would then max out my HSA, which is a health savings account, which I believe is the most tax advantaged account that I know of. Tax-free contributions, tax-free growth within the account, and tax-free withdrawals if used for qualifying medical expenses. But to my knowledge, it's pretty flexible what qualifies as a medical expense within the HSA, so it's pretty cool. Okay, slightly more exciting now. After those retirement accounts and my needs came my liquid assets. I would keep enough in my checking account, that's what I consider liquid, like easily accessible, for my needs, which we already covered, and my wants. So stuff like travel, clothes, pillowcases, I don't know, stuff that I want. Pretty unscientifically determined amount of money here, but I generally kept a few months worth of expenses liquid. Final filter, whatever was left over, I would invest in my brokerage account, and we'll cover my investment strategy in the next section because it really hasn't changed too much over the years. So that's what I used to do when I had a corporate job and YouTube income. And to reiterate, if you're entering the workforce or you've been in the workforce for a bit but are still figuring some of these things out, which is fair because it is super confusing, I by no means have it all figured out, but I do think that this method was a pretty good one that took advantage of retirement accounts and employer matching, tax benefits, etc., which I would recommend doing if you can afford to set that money aside. And on that point of if you can afford to, I know I talked about maxing out all these accounts. I'm just one person. I only have myself to take care of, so I was able to set that money aside, but I very much recognize that is not realistic for everyone. But to the extent you can, saving or investing even a little bit is better than nothing. Okay, what I do now. It is quite different than what I used to do. I no longer really go through the same filtering method for two main reasons. The first reason is that I do not have consistent income anymore. When I was a consultant, I got paid every 2 weeks for the same exact amount without fail. Now, I do get a monthly check from YouTube ad revenue, so that's consistent, but for my biggest income stream, brand deals, it is not consistent. Sometimes I'll do a few brand deals back to back and have a nice cash flow going, and then other times I will go 8 weeks without a brand deal paycheck. And so because my cash flow is so lumpy, it's not as intuitive to me for it to flow through these accounts the same way. And the second reason, more importantly, is that I'm now self-employed, as I've already said 100 times in this video. So I can't even contribute to some of the retirement accounts that I had access to before, even if I wanted to. So I will walk you through what my process looks like now. I'd say it's a little bit more of an art than a science these days. You'll see what I mean. So starting with my investments, when my income was less lumpy, I like that, lumpy. It works, you know what I mean? I would invest a pretty consistent amount on a monthly basis. These days, I basically decide how much to invest based on how thick my liquid assets are looking. Again, more of an art than a science. You know it's an art when I'm calling my liquid assets thick. So in other words, when my paychecks come in and my account has a nice little cushion, I will transfer a big portion of that into my brokerage account to invest. And then if I go many weeks without a paycheck, I will hold off. All in all though, I invest a majority of my income and leave a few months of expenses liquid the same way that I used to. And what do I invest in? Pretty much as it's always been, I have 80% of my portfolio in ETFs or mutual funds that track the S&P 500. For the longest time, I stuck almost entirely to VU, which is Vanguard's S&P 500 ETF, but recently switched over to SWPXX. SWPX, which is Charles Schwab's mutual fund that tracks the S&P 500. I switched over because it has a lower expense ratio of 0.02% compared to VU's 0.03%, which is funny because just a few years prior, I switched over to VU from SPY for the same reason. So let me know if there's one that's even lower than SWPX. And since I just set and forget most of my investments, I don't really care about being able to buy and sell throughout the trading day, which you can do with an ETF, but not a mutual fund. A mutual fund trades only once per day after the market closes. Also, as I'm talking, I realize how US-centric this video is, so sorry, but I'm American. And the other 20% of my portfolio is in individual equities. There's nothing crazy in there. It's mainly blue chip stocks with the exception of a few. Mainly tech, payment services, some cybersecurity, some agricultural stuff actually. But that is not investment advice. I should have started with that. And because I know some people will ask, to this day, I have never invested a single penny in cryptocurrency. So while the risk profile of my portfolio is pretty safe, historically speaking, I am aggressive in terms of my investments being 100% in stocks versus bonds or something a little less volatile. But I'm still young, so I don't really expect that to change in the foreseeable future. Now, when it comes time for me to make a large purchase, like a down payment on a house or, family planning, like many years in the future, I will, of course, plan ahead and probably keep more of my assets liquid. But for the most part, I think I'll maintain the same kind of strategy and hopefully expand my investments to other asset classes like real estate, but that's not till I leave New York, so this is in the future. Okay, next is my Roth IRA. I'm still doing the filtering thing, so maybe I do still think about it though. Okay, my Roth IRA, which as I mentioned earlier, I still max out today, as I did when I had a corporate job, but I have to do it a little differently now because once you reach a certain income level, you cannot contribute directly to a Roth IRA. But you can do it via a backdoor method, where you first contribute to a traditional IRA and then convert it, roll it over to a Roth IRA. I've done the backdoor method the last couple years, and it's actually pretty easy, even though it sounds really complicated. Just Google it. Okay, so next, unlike my Roth IRA, which I can still contribute to as someone who's self-employed, I can no longer contribute to the 401k since that's a type of retirement account set up by my employers. But pros and cons here, because what I can now contribute to is something called a SEP IRA, which is a type of retirement account specifically designed for self-employed people and small business owners, which is pretty cool. I actually just learned about it. And the contribution limit is high. You can contribute up to 25% of your total compensation or a max of $69,000 for this tax year, whichever is smaller. Again, I didn't even know this type of IRA existed until the whole career change recently, but it's cool that options like this exist. Yeah, not sure I'm gonna max this one out this year, but we'll see. I don't know how my income's gonna shake out by the end of the year. So last thing on the whole SEP IRA versus employer setup 401k. A lot of people in my spicy Q&A poll on Instagram, follow me over there, asked me if I was concerned about missing out on things like the 401k match since leaving consulting. I was gonna address this in my spicy Q&A video, but it wasn't spicy enough. To answer the question here though, I really am not concerned about it. I mean, of course, the 401k match, for example, is a great perk that I took advantage of when I had access to it, but pros and cons, there are these cool types of retirement accounts that are set up for entrepreneurs that I'm now learning about. And yes, I have lumpy income now, but the price of doing something that I love and working for myself, kind of. Okay, now I don't know if this is interesting, but I think it's important. It's a couple things I now pay for as a self-employed person, because everything up until now that we've discussed is kind of places where I file my money away. Beginning with estimated taxes, now that I'm basically an independent contractor, I don't have an employer to withhold money from my paychecks to set aside for taxes. So I have to do that for myself now by estimating how much I'm gonna make in the full year and paying the respective taxes every single quarter. And again, I know taxes, kind of a dry topic, but it's definitely a big part of what my personal finances look like now. And so I'd be remiss to not include it, at least a little bit, in this video. And health insurance. So before, where my former consulting firms would pay for my health insurance, and let me tell you, BCG's health insurance specifically literally could not be better. And that was a perk I really appreciated, but I now pay for my own. I looked through the plans and found one that I think makes the most sense for me as a healthy person who really just wants one annual health checkup, annual women's health checkup, maybe a couple urgent care visits every year, like a couple months ago when I had the flu, which was not fun. So it's a high deductible plan that will basically keep me from going bankrupt if, God forbid, something catastrophic happened. And so circling back to the HSA, that triple tax advantage account that we talked about earlier, you can still contribute to this if you're self-employed, if you're under a qualifying high deductible health plan. I believe mine doesn't qualify, but honestly, I'd have to double check. Regardless, I'm a little bit bearish right now on maxing out a lot of these accounts that I used to, because due to my lumpy income and this being like my first year of self-employment, I'm not sure how my income is going to shake out by the end of the year. And so I'm being a bit more conservative, I would say. Which actually brings me to our final section. Looking forward, how do I want this strategy to change? And what are some reflections on how it looks like right now? So I'm sort of treating this year as a trial year, again, to see how things kind of shake out before doing anything big, or honestly, even before maxing out some of these accounts, like I already said. Of course, I have some idea of what I'll make. I have my run rate formula in Excel to calculate how much I will make by year end based proportionally on how much I've made up until this point in the year. Hence the title of this video that I put out. But that number can change pretty drastically, pretty quickly in either direction. I do plan for that number to be even bigger, but that's because I'm an optimist and because I'm working on things to make my income less lumpy. That's definitely a big goal of mine, but kind of a different topic. So yeah, I'm gonna see how things go, roll out a couple exciting opportunities in the near future here, and then reevaluate after that. And again, so you don't miss the announcement on what those exciting things are, sign up for my email newsletter, link in description. Anyway, guys, as you can probably tell, I'm still learning the ins and outs of all these little, personal finance things, especially as a self-employed person. So if you know any tips and tricks that I'm missing, please leave it in the comments below. There are a lot of personal finance aficionados on this corner of the internet, so I'd love to hear from you, get a little dialogue going in the comments where we can help each other. Like and subscribe if you made it this far, found this valuable, it helps me out a lot, and sign up for the email list, link in description to find out the fun things very soon. Until next time, Turtle out. Also, I never show the behind the scenes of my setup, but this took some doing. I put this white door here as a reflector. I put the chair out there because it was too dark if I sat here. I had to get some light on my face. Even still, didn't have a lamp, so my face was kind of dark in this video. But talk about a cool background. Authentic British. Thanks for watching.